Welcome, dear traders. Markets started the new trading week with the cautious trading in anticipation of key decisions from the world's two leading regulators. Japanese markets are closed today for respect for the 8th day. Chinese stocks are trading moderately higher. Meanwhile, stock indexes in Australia and in New Zealand were lower today, following negative signals from Wall Street on Friday. Let's have a look at other factors that influenced Monday's trade. It's me, Kate Tichina, and you are watching a recap of the Asian session on September 18. On a Friday, Wall Street stocks declined amid mixed U.S. economic data. The data showed that industrial production strengthened in August. On the other hand, consumer sentiment weakened. At the same time, U.S. inflation expectations also fell. For the time being, this may give the U.S. Federal Reserve some room to keep interest rates unchanged and increase fears about a rate hike in the future. Oil is also on a track for its biggest quarterly gain. In the long run, inflation is likely to pick up under the pressure of expensive energy. Ahead of the Fed's interest rate decision on Wednesday, risk-aversion sentiment dominates markets. New stimulus measures from Beijing also supported oil's growth prospects, and the increase in the Chinese refinery production and the high export profits will boost demand in the world's largest oil importer. As a result, Chinese stock indexes are standing out of the general downtrend today. Moreover, Chinese investors do not seem to be concerned about the gloomy outlook for the real estate developer Evergrande Group. Shares of the developer plummeted by nearly 25% after a decision to restructure its debt was postponed. Reportedly, some employees of Evergrande Group's asset management unit in Shenzhen were arrested. And this raises concerns about increased governmental oversight of the troubled developer and the future of Evergrande Group. In addition, the Chinese authorities are trying to control the exchange rate of the national currency. Beijing's tendency over several months to set a tighter than expected official fixing of the yuan is seen by markets as an attempt to stem its rapid decline through political orders. In addition, the People's Bank of China is scheduled to make another decision on its interest rates on Wednesday. Moreover, market expectations are that Beijing will keep the rates at their current record low levels. On Wednesday, investors will assess the Federal Reserve's interest rate decision, and the majority believes that the U.S. regulator will leave its key rate unchanged on September 20. The CME FEDWATCH tool shows that this figure reached a record 99% today. Given that the ECB raised its key rate to 4% last week, will the Fed follow suit? The resilience of the U.S. economy allows the Fed to remain hawkish for an extended period. This means that the U.S. regulator is unlikely to announce the end of its tightening cycle this month, as the European Central Bank has done. The FEDWATCH tool demonstrates that the market expectations for a rate hike at the next meetings is 28% on November 1 and over 40% on December 13. As a hawkish sentiment intensified last week, markets also expect higher and longer-term interest rates. Against this backdrop, the U.S. Treasury yield soared, with the 2-year Treasuries reaching the 5% level. The US dollar index, which measures the performance of the greenback against 6 other major currencies, ended its 9th week with an overall gain of 0.3%. On Monday, it remained near the 6-month high, near 105.30. As investors await the most important decision of the week and the months, the US dollar also went into consolidation. In Asian trading, it traded higher within a narrow range of 105.20 and 105.40. Meanwhile, interest rate decisions from the Bank of England and the Bank of Japan are also expected this week. The Japanese regulators' meeting will take place on a Friday and will be the main event of the week in Asia. Recent statements from a Bank of Japan head, Kazuo Ueda, have drawn investor attention, and the governor touched upon an inevitable drifting from the ultra-loose monetary policy. However, some analysts believe that markets may have misinterpreted the Japanese regulator's comments. The fact is that wages in a country are falling because of the weak yen. The country's authorities are urging companies to increase payments to reduce this imbalance. In any case, the Bank of Japan may be forced to remain ultra-loose in the face of the recent weakening of wages and a possible softening of the price level. At the same time, other arguments in favor of a tightening are still not very strong. As a result, the dollar-yen pair begins this week consolidating in a narrow range between 147.50 and 147.90. The yen depreciated by 1.3% in the week following Kazuo Ueda's statement on the possible monetary policy change. Since the beginning of 2023, the yen has already lost over 11%, and this means that the pair may go higher if the head of the Bank of Japan sticks to a dovish stance and dispels hopes of a tightening in the future. Today, markets are cautious due to anticipation of the Fed decision on Wednesday. As a result, the yen ended Monday's Asian trading session strengthening against the US dollar at 147.70. The antibody in currencies also strengthened slightly against the US counterpart early Monday. Tomorrow, markets will focus on the minutes from the Reserve Bank of Australia. If investors see hints about a possible extension of the interest rate pause, bulls will unlikely appreciate it. Notably, the Australian regulator has kept its rate unchanged for 3 consecutive meetings. However, the Australian currency is more likely to react to external factors than domestic indicators. Today, the Aussie is growing on high oil prices and on the consolidation of the US dollar. The Aussie dollar pair moving in the range of 0.6427 and 0.6451. Despite today's growth, the Australian dollar still lacks technical bullish momentum. However, the pair still has a chance to test the resistance of 0.6485 until the support of 0.6385 remains intact. At this point, the pair has slim chances of breaking through the resistance level, as the Australian dollar has retreated significantly from its morning highs and closed the Asian session at 0.6444. Today, the Kiwi dollar pair is also trading higher, near 0.5910. Despite weak domestic economic data and mixed news from China, the Kiwi is starting the week on a positive note within the daily range of 0.5897 and 0.5921. The New Zealand dollar is likely to receive support from a bulls in anticipation of a dovish decision from the US Federal Reserve on Wednesday. However, disappointing consensus forecast for the New Zealand's economic growth and inflation figures may hamper this positive sentiment. In addition, there is a risk of a further deterioration due to the decline in the New Zealand exports to the Chinese market. And that's all for now. Leave your comments below and don't miss our next video review. Remember that staying up to date is the key to success in your trading. See you online soon.